Hello friends, I am Shailesh and I will be taking you through accounting concepts today. So let us discuss what are the topics that are going to be covered today. First is we'll see what is accounting. Next, we'll discuss about the principles that are adopted while doing the accounting. Then we'll discuss about what is an account, and then we'll discuss about the various types of accounts that are there. Then we'll discuss the rules of accounting that are followed by each account. Then what is double entry system of accounting. Then we'll be discussing about the basic documents which are used while doing the recording of accounts. We will be then discussing about the various financial statements that are utilized, and then accounts compliance and accounts compilation and reports. So let us understand the importance of accounting. Accounting serves as a backbone of every business. There is something known as cash inflow and cash outflow, which has to be recorded for each business. Now, is accounting taking place only in businesses? If you look at it, in our day-to-day life, every one of us does a basic accounting. Like, what is the income that I have? Against that, what are my various expenditures? And after making all those expenditures, what is my savings? Based on those savings, what are the things that I can invest into? All this planning that we are doing completely as a package is known as accounting. What you are doing on a day-to-day basis is you are trying to identify what is your current status, current financial status. Similarly, every business year on year requires this kind of information. In a business, you would like to do certain investments in your fixed assets. You may want to do investments in certain technology. You may want to do investments in certain property. When you want to show your financial status to your stakeholders, like the shareholders or maybe the banks, in such case, everybody would look into your financial statements, and the financial statements will be prepared based on the accounting. So what is accounting? Accounting is first identifying a transaction. Second, it is about recording that transaction. Then classifying into various journals and ledgers, and finally posting those closing balances from those ledgers to the reports. Finally, when the report comes out, those reports are known as financial statements. So what are the principles of accounting? First is revenue realization. Accounting follows certain principles. We should know these principles before we start doing the accounting. So the first principle of accounting is revenue realization. What do you mean by revenue realization? Revenue realization is revenue which is earned, and income which is earned, and it is recorded on the date of its realization. It is vital for any business to determine the income pertaining to any accounting period. I hope revenue realization is clear to you. The revenue is considered realized only when the money is received. The income is earned. The second principle of accounting is matching concept. It's an expense which is recognized in the same accounting period as the related revenues are recognized. So expenditures which are done against the revenues in the same accounting period are known as matching concepts. Okay, we'll repeat these two again with an example. Revenue realization. Revenue realization or a revenue is considered as income earned on the date when it is realized, when the money is actually received. There are certain transactions in businesses where the income is billed on a different date and the money is received on some other date. Let's take a very simple example. A milkman. Milkman continues to supply milk for a month. That sale of milk is an income for him. However, the revenue is considered to be realized only when the milkman receives money from his customer. That is revenue realization. Income is already there as a part of sale, but it is considered to be realized only when the money is received. I hope this is clear. The next principle that we spoke about is the matching concept. The expenses which are incurred in the same accounting period as of the revenue received is known as matching concepts. Let's say you have an income as a part of salary which is available in the current month, which is generated in the month of March. Whatever expenditures you are doing in the month of March are considered to be the expenses and revenue for that particular month. So your matching concepts is revenue which is done in the month of March, that is incomes in the month of March, and expenses which are there in the month of March. Accrual method of accounting. Transactions are recorded based on income earned or expenses incurred irrespective of actual receipt or payment. Accrual method is a slightly different method than the revenue realization. When you are talking about accrual method of accounting, it is the milkman continuing to supply the milk and considering that supply of milk as an income, as a revenue, as a sale, even though the money has not been received as of today. Going concern concept. The business functions without any fear of liquidation. Liquidation means it no longer has money to continue its business operations. So what we are talking about going concern concept is the business continues to function without the fear of being liquidified for the foreseeable future. Usually this foreseeable future is a period of at least 12 months. We'll move to the next principle of accounting, that is accounting period. What is an accounting period? It is a period in which the books of accounts for any entity is prepared. Generally, this period is of 1 year. That is, in India, it starts in the month of April and ends in the month of March next year. So, current financial year or accounting period is 1st April 2012 to 31st March 2013. What is an accounting entity? An entity which is going to take care of the accounting, for which the books of accounts are getting prepared. So, assuming that the accounting is taking place for an organization, ABC and company, that is known as an accounting entity. The business owner is not an accounting entity. If the business owner's books of accounts are getting maintained, not the ABC and company, then business owner becomes the accounting entity. Is it clear? The accounting financial reports which are getting prepared, if they are being prepared for an organization, then the organization becomes an accounting entity. And if the books of accounts are being maintained for a business owner, for an individual, then that particular individual becomes the accounting entity. So, an organization and the business owner are two separate entities, are not the same entity. Money measurement. The business transaction and events of financial nature alone are recorded. So, any transaction which has taken place between two people, if there is a money transaction happening, only then those transactions will be recorded. If I am selling material to a customer, and if the customer is going to make payment towards that to me, then those transactions will be recorded in the books of accounts. Assuming that I have given a glass of water to somebody, and I am not expecting any financial returns on that, then that transaction is not considered as a financial transaction or an accounting transaction. Okay? So there are 7 principles of accounting that we have covered right now. I'll show you those again. The principle of accounting, revenue realization, where income earned is considered to be a revenue only when it is realized, when the money has been received. Matching concepts, the expenses and incomes of a same period, same accounting period, are called matching concepts. Then we spoke about accrual method of accounting, where the transaction is recorded on the basis of income earned or expense incurred, irrespective of whether the actual money has been received or the payment has been made. Then going concern concept, where we said that the business continues to operate without the fear of liquidification or liquidation for a foreseeable future, approximately 12 months. Accounting period, the period for which the accounts are getting maintained. Generally, a 1-year period is considered to be an accounting period. An accounting entity, business, which is maintaining the accounts, is considered as the accounting entity. The business owner is a separate entity and not an accounting entity in case the books of accounts are being maintained for a business organization. Money measurement. The business transactions which are financial in nature, only those will be recorded in the books of accounts. Okay, what is an account? Any transaction which is going to be recorded against an account. It is a place where your transactions will be recorded. Okay. Now, what are the different types of accounts? There are basically 5 types of accounts that you would see. A person, an individual, an institution, an organization, which is known as a personal account. Assets, computers, let's say television, or maybe furniture, fixture, land and building. All these are assets using which the business operates. Liabilities. Generally, the accounts to which I need to pay at a later date is a liability for me. Salary payables to employees, which we have not paid, we are supposed to pay in the next month or a quarter. Those are liabilities for me. Similarly, I may owe some money to somebody. That is a liability. A business owes a capital account to its investor. The investor invests some money into the business in the hope that the business will repay him through profits. So that capital investment, the capital account, is a liability for the business towards the business owner. Expenses. Any expenditure that I do in my day-to-day business for which I spend money, that is an expense. Incomes. Incomes could be in the form of sales. It could be in terms of any other revenue generating mechanism. Rent. I may give a piece of land to somebody on rent. That becomes an income for me. So there are 5 types of basic accounts: a person, an asset, a liability, an expense, or an income. Now these types of accounts can be classified into 3 types of accounts. First is personal account, second is real account, and the third is nominal account. So what are the principle of accounting or rules of accounting do these accounts follow? If it is a person or if it is an institution and an organization, it will be classified as a personal account. Now a personal account follows the golden rule of accounting, saying debit all receiver and credit all giver. I'll repeat that. Any person, organization or institution with whom I transact as a business are known as personal accounts. And these personal accounts follow a golden rule of accounting, that is debit the receiver and credit the giver. So let's take an example that I am in transaction with ABC and company. I sell goods to him. In this scenario, ABC and company becomes the receiver of goods or services that I give to him. So when I am recording a transaction for this sale, what am I going to do with him? With his account? I will be debiting his account in the transaction because he is the receiver of the sale or service. Right. In case ABC and company is going to make payment towards those sales and services, then in that case, since he is a giver, I will credit his account towards the sales and services. Okay? Right. Then there are real accounts. The assets and liabilities that we discussed in the previous slide are the real accounts. Right? So the real accounts will follow a general rule of accounting, that is debit what comes in and credit what goes out. So let's take an example of furniture being bought. Now when I buy furniture, what is happening in that case? The furniture is coming into the business. Therefore, when I am passing the transaction for furniture, I will debit the furniture. Okay. Now let's take an example when I am dealing with a party and I am going to pay cash to him. So what is happening with the cash? Cash is an asset, is a current asset for me. The cash, being a real account, will follow the rule of real account. That is, since cash is going out of the business, I will credit the cash. So the rule for real account is debit what comes in, credit what goes out. Okay, the nominal account. My expenses and incomes will be classified as nominal accounts. Nominal accounts because these accounts are going to be done in the current financial year, and the balances of these accounts are not going to be carried forward into the next financial year. The behavior of the personal account and real account is such that their balances may get carried forward into the next financial year. Let's say in a scenario of a personal account, if I buy goods from somebody and I keep paying him at the later date, it's not on the same date, then in that case whatever balance is available will get carried forward to the next day, and in case I don't pay up that money in the current financial year, that balance will get carried forward into the next financial year. That is the behavior of certain accounts. Assets, if these assets are going to be continuously with me, like the furniture, if I have bought furniture, I will be utilizing it for the period of more than one financial year, then in that case the balance that is there for those furniture, the amount that I have invested into that furniture will continue to be there till the business goes on, or till the time the depreciation value of that or the value of that furniture becomes zero. Okay, but in case of a nominal account like conveyance, once I made payment towards the conveyance, that balance is not going to get carried forward to the next financial year because it is over. Similarly, any income that I have received as of today, like a rent, if I have received it, the money is taken, the account is closed, there is no balance left. So nominal accounts generally don't get carried forward into the next financial year. And what principle of or the rule of accounting do they follow is the nominal account, the expenses will be debited and the incomes will be credited. So let's say if I have made payment towards conveyance, then the conveyance being an expense, because I have made payment towards it, conveyance being an expense, I will debit it. And when I receive rent, because I am receiving rent and it is an income for my business, it will be credited. We'll take an example of a transaction. Let's say rent received rupees 10,000 in cash. So how many accounts are getting affected by this transaction? There are two accounts which are getting affected because of this transaction. One is rent account, which is an income, because I am receiving the rupees 10,000 in the form of rent. But what am I receiving as a rent? The cash. So there are two accounts which are affected over here because of this transaction. One is rent, an income, a cash, which is an asset. So rent as an income will follow the rule of accounting of nominal account, which is debit all expenses and credit all incomes. So now rent being an income will be credited for rupees 10,000 and cash being an asset, a real account. We follow the rule of accounting for real account, that is debit what comes in and credit what goes out. Now since cash is coming into my business, I will debit the cash account. Now what is a double entry system of accounting? Generally accounting follows double entry system. That means every debit should have an equal credit. Right? So taking an example again of the rent. Rent received. Rent received rupees 10,000 in cash. So what is the transaction going to be? Debit cash rupees 10,000. Credit rent rupees 10,000. So I have received cash, how much? 10,000. But this 10,000 is received against what? It is received against rent of rupees 10,000. Okay. So every debit should have an equal and corresponding credit. That is the double entry system. Okay. So what are the basic documents used for financial accounting system? So there are 5 documents that have been listed out in this presentation. First is the voucher. The voucher is a document where you will record your complete transaction. I will repeat. Voucher is a document in which you will record the entire transaction, including the narration. The narration is a part of the document where you describe what has happened in the transaction. So voucher is a document in which a complete history of the transaction is recorded. Second is receipt. When you receive money from a person, you are supposed to record this receipt in a document which is known as receipt. Next is invoice. Invoice is a document which is exchanged with your customer. Invoice gives the complete history of what is the material bought by your customer, at what rate, and if there are any additional expenses that need to be paid by the customer. This document also carries the information about customer, his name, address, contact details, and the other tax related registration details. It will also carry the date of the invoice, the date of the transaction when this sale had happened. A journal. any kind of adjustment that you want to make towards your accounts will be recorded in a journal. In fact, journal is a record which gives you information regarding the entire list of transactions that have happened from the book's beginning till the end of the books. Ledger. All the transactions which are recorded under a journal are then posted into their respective ledger accounts. So when we say rent, debit cash, credit rent. So when you say debit cash, a respective posting should happen in the cash account saying that rent has been received rupees 10,000. Similarly, there is a rent account in which this record has to be made. So a ledger is a record where all your journal entries, all your transactions will be posted, and finally a closing balance will be arrived at. So what are the different types of financial statements? There are three which have been listed out over here. One is trial balance, the second is profit or loss account, and the third is balance sheet. Trial balance is a statement which gives you all your debit and credit transactions. All your debit and credit ledgers will be listed into this trial balance, and a statement will be prepared to check whether your debit and credit balances match or not. If the balances match, then the businesses go forward and prepare their profit or loss account and balance sheets. So you can say that to match the debits versus the credits, first a trial balance of all the financial statements is prepared. And if the debits and credit totals match in the trial balance, then the further statements are prepared. Profit or loss account. What is a profit or loss account? Profit or loss account is basically divided into two parts. One is the trading account and the next is the profit or loss account. The trading account gives you information related to all your business related incomes and expenses which are directly related to your business, like the purchase account, the sales account, the opening stock, the closing stock. All these details are arrived at in the trading account, the balances of which are recorded in the trading account. Finally, the debit and credits will be matched, and whatever is the balance. So your debits are your expenses, credits are your incomes. So balance, whatever is available, will be either taken as a gross profit or a gross loss. In case the income side is higher than the expense side, then a gross profit will be arrived at. In case the debit side is greater than the income side, then a gross loss will be arrived at. And finally, the gross loss or the gross profit will be carried forward into the profit or loss account, which will have all your administrative expenditures and incomes, like your salaries, wages, and other things will be displayed in the administrative expense through profit or loss account. From the gross profit or the gross loss, your expense and incomes which are captured under the profit or loss account will be deducted, and finally a net profit or a net loss will be arrived at. This net profit or net loss is then carried forward into the next financial statement, that is balance sheet. And then this profit or loss is divided or given to the proprietor or divided between the partners into their capital accounts. Now balance sheet. Balance sheet is a financial statement which gives you the complete history or the complete valuation of your assets and liabilities. This is a statement which will give complete information about the financial status of an organization. So, what we discussed right now in the financial statements are three things. One is trial balance, which gives you the information related to whether the debits and credits of your transactions are matching or not. In case they are not matching, then you have to revisit your accounts and check what were the mistakes. In case it is matching, then these balances in the trial balance is then moved into the next financial statement, that is either profit or loss account or the balance sheet. Profit or loss account being broken up into two parts, trading account and profit or loss account. Trading account gives you complete information about your expense and incomes which are directly related to your business. Purchase, sales, stocks, the value of these will be displayed in the trading account. Then expenses which are debit, incomes which are credit will be then deducted from each other, and a gross profit or a gross loss will be arrived at. This gross profit or a gross loss which is coming from the trading account will be transferred into profit or loss account, from which your administrative incomes and expenses will be deducted. And finally, the figure which you arrive at is the net profit or a net loss. This net profit or net loss is then transferred into a balance sheet, which gives you complete information about the assets and the liability that the company holds. The net profit or net loss, which is then transferred from profit or loss account, is then deducted from the capital account of your added to the capital account of your business owner or business proprietor or the partners. And then when the balance sheet is prepared, it will give you the complete understanding about the business's financial status. So how are accounts compiled and reports made? First, you will record the vouchers. Vouchers where you give the complete information about the transaction that has happened, including the narration, which gives the complete history about what the transaction was all about. Then classifying. This voucher entry is then moved into a journal entry, where you debit and credit expenses, incomes, real accounts, personal accounts, nominal accounts. Then once the journal entry is completed, you will then post it into the ledger accounts. A balance of that ledger account will be then arrived at, which is known as the closing balance. And this closing balance is then moved into the trial balance to match whether the debits and credits are matching or not. And then finally, once the consolidating of trial balance is completed, if the balances that are there in the trial balance are matching, then the reports will be generated. Those reports are known as profit or loss account and balance sheet. So now let us recap whatever we have spoken about. First, we have taken an introduction towards accounting. We understood what are the principles of accounting. Then we understood what is an account and what are the different types of accounts. Then we spoke at length about the rules of accounting, where we discussed about the golden rules of real account, personal account and nominal accounts. Then we spoke about double entry system, where we said that the debit and credit totals or the debits in a transaction should have an equal and opposite credit. Then we spoke about the source documents like voucher, receipts, journals and ledgers. Then we spoke about financial statements like trial balance, profit or loss account and balance sheet, and we give you the definition, and we spoke about how these statements are different from each other. Then we spoke about accounts compilation and the reports. Thank you, and do join me in the next video session.